The precious metals market just experienced a devastating collapse. Gold plummeted beneath the $4,800 mark. Silver suffered a catastrophic 10% nosedive in just one trading session. And here's what you absolutely must grasp. This wasn't driven by a shortage of buyers. The root cause? Something far more systematic and dangerous. Let me explain exactly what unfolded, the triggers behind it, and the critical implications moving forward. Before we dive in, let me be crystal clear about something. I don't offer paid courses, no signal services, no mentorship programs, zero paid products whatsoever. If anyone reaches out claiming to represent me while pushing products, they're scammers. Block them instantly. I provide this market analysis completely free because this community has repeatedly shared how it helps you grasp market realities. Examine multiple perspectives and make smarter choices. That's my motivation. Drop a comment below right now. Which country are you in? What city? I'm curious to see how international our audience has grown. And be honest, did you hold silver positions during the sell-off? Did you anticipate it? Or were you blindsided? Share your genuine experience below. Let's walk through the sequence of events because the order reveals the causation. COMEX gold futures broke beneath $4,800 per ounce for the front-month contract. This psychological threshold matters tremendously. Round number breakdowns activate algorithmic selling. Trading systems execute sell orders when specific price points fail. Stop-loss orders get hit, transforming controlled selling into frantic liquidation. Silver experienced an even more brutal decline, close to 10% in one session. By historical measures, that's extraordinary. Market reports confirm this ranked among the sharpest declines in recent memory. This happened right after an early week bounce, when traders believed recovery had begun. They were mistaken. Multiple elements converged to drag gold prices down. First, the US dollar index gained strength, raising gold's cost for international buyers using alternative currencies. Second, US Treasury yields climbed higher, diminishing the attractiveness of assets like gold that generate no interest income. Third, profit-taking emerged after gold reached unprecedented highs earlier this year. Fourth, declining geopolitical risk premiums reduced safe haven buying interest. Bottom line, capital left the table. Silver's decline was significantly more aggressive. Understanding this requires examining how this market actually operates. Quick question. What's your local time right now? Morning? Afternoon? Late evening? Comment below. I'm genuinely interested in when people globally consume this content. Are you watching before market open to prepare? After the close to process what happened? Let me know. Here's the most crucial element to understand about this silver crash. The initial trigger was Kevin Worsh's nomination as Federal Reserve Chair. Markets had spent months positioned for continued accommodative monetary policy and future rate reductions. The consensus trade, weaker dollar expectations, rate cut bets, everyone crowded into the same positions. Worsh's reputation as a strict inflation hawk demolished those assumptions. His nomination signaled monetary policy would stay tight far longer than anticipated. Not just weeks, potentially much longer. Markets had priced in multiple rate cuts. Those expectations required immediate recalibration. When expectations shift so drastically, position unwinding begins. The dollar responded instantly, surging upward. For silver, a dollar-denominated asset frequently used as a currency debasement hedge, this proved decisive. If your silver position assumes dollar weakness and the dollar suddenly strengthens, your entire investment thesis collapses. You don't wait around, you exit. When mass exodus happens simultaneously, prices crater. Positions constructed on dollar weakness assumptions unwound rapidly. This turbocharged the downside in ways completely disconnected from actual silver demand. Industrial purchasers didn't reduce orders. Solar manufacturers didn't stop requiring silver. The physical marketplace remained unchanged overnight. What transformed was the financial positioning layered atop the physical market. And that positioning was enormous. Now, something that appeared bullish superficially turned out to be a structural weakness. The iShares Silver Trust, SLV, absorbed massive capital inflows during the days preceding the crash, including an extraordinary $3.5 billion in a single session. That's tremendous money flowing into one silver investment vehicle in one day. Superficially, these inflows seemed bullish. Money entering silver ETFs equals strong demand, right? Wrong. These inflows concealed a structural vulnerability that would later devastate the market. When prices started falling, ETF mechanics reversed. This is critical because it explains how apparent demand became supply. When investors redeem ETF shares, authorized participants must liquidate physical silver to satisfy those redemptions. Large-scale redemptions forced authorized participants to dump physical silver into an already declining market. The demand surge rapidly transformed into automated supply. Selling pressure became self-reinforcing. Declining prices triggered additional redemptions. More redemptions pushed prices lower. Lower prices triggered even more redemptions. A feedback loop emerged, where the ETF structure itself magnified the movement. The mechanism designed to provide liquid silver exposure became a transmission channel for cascading selling. Question for the community: how many of you hold silver through ETFs like SLV versus owning physical metal? Comment below. Understanding this distinction matters enormously in environments like this. Physical holders can't be forced to sell through redemption mechanics. ETF holders participate in structures that amplify volatility bidirectionally. As prices collapsed, price-influenced flows plunged deep into negative territory. How deep? Over $11 billion in outflows. Let me emphasize that figure. $11 billion in price-driven outflows. That's institutional capital abandoning silver at scale. Here's the part every retail investor should consider carefully. Institutional investors utilize late-stage retail inflows as exit liquidity. While public capital still entered ETFs, while retail traders still bought dips, futures markets were already breaking down. The divergence was striking. Retail buying met institutional selling, quietly transferring risk from institutional portfolios to retail portfolios before complete market unraveling. In plain language, while you bought because prices looked attractive after pullbacks, institutions sold to you because they anticipated the breakdown. They used your buy orders to close their positions. When the final crash arrived, you held the exposure. They held cash. This is standard market functioning. Smart money exits into retail-provided liquidity. Not conspiracy, just mechanics. But understanding it helps you avoid ending up on the wrong side. Approximately 60% of current viewers aren't subscribed to this channel. If this analysis helps you understand mechanics mainstream media ignores, if it demonstrates how institutional money actually behaves, consider subscribing. I don't hype. I don't fearmonger. I explain mechanics, present data, and let you decide. If that resonates, subscribe. Let me explain the final acceleration, where market infrastructure itself became problematic. As volatility spiked, the CME Group took aggressive action, raising margin requirements for silver futures from 11% to 15%. That might seem like a minor adjustment. It's not. When margin requirements increase, leveraged traders must post additional capital immediately. Not next week, not tomorrow, immediately. Most traders lack significant excess capital ready for margin hikes. When the call comes, two choices exist: wire additional funds within hours, or liquidate positions to meet new requirements. Most sold. They had no alternative. This margin squeeze amplifies, rather than reduces volatility, by forcing leveraged traders to sell into already falling markets. Margin hikes fuel the fire. The CME's stated objective is protecting clearing members and ensuring market stability, but the immediate effect is forced liquidation, accelerating price declines. Simultaneously, something else happened in the options market that worsened conditions. The options market flipped into negative gamma. Let me explain because it's technical but important. When dealers sell call options to speculators, they hedge by purchasing futures. As prices rise, they buy additional futures to maintain hedging. This is positive gamma. Their hedging activity supports rallies. When prices fall, that dynamic reverses. Dealers who had hedged large call positions were forced to unwind those hedges as prices declined. They had to sell futures to stay hedged, adding to futures pressure already coming from margin calls and ETF redemptions. Three simultaneous selling pressure sources: ETF redemption selling as the feedback loop engaged, margin call selling as traders faced forced liquidation, options hedging selling as dealers unwound positions. All three hit simultaneously. This created the cascade. This explains silver's 10% single session drop. Not because demand fundamentally changed, because market mechanical structures amplified selling into a waterfall. Direct question for the community: did you understand these mechanics before this video, or is this new information? Comment below. I'm asking because I want to know what detail level helps. If this is too technical, tell me. If you want more analysis like this, tell me that too. Now the question everyone's asking: is this healthy correction or trend reversal? This is the critical question, and I want to provide a balanced answer. Many analysts still believe gold's long-term outlook remains positive due to several factors. Central bank buying continues. Geopolitical risks remain globally elevated. High global debt levels support hard asset cases. These structural factors haven't changed because of one volatile week. However, short-term corrections are normal after strong rallies. Gold rallied significantly in recent months. A pullback doesn't automatically signal the bull trend ended. It may simply mean the market overextended and needed consolidation. For silver, the picture is more complex. Silver behaves as both precious metal and industrial metal. When global growth concerns rise, silver tends to face heavier selling because industrial demand represents such a large total demand component. The earlier analysis stated clearly, silver failed responding to supportive narratives around inflation, geopolitics, and supply constraints. When assets fail responding to bullish catalysts, that reveals something about positioning and sentiment. Capital gets frustrated and exits. Let me give you key technical levels to watch because price action will reveal much about what comes next. For COMEX Gold, watch support near $4,750 and $4,700. If gold holds above $4,700, a bounce is possible. Breaking below that level cannot rule out further downside. For resistance, watch $4,850 and $4,900. Those are levels gold needs reclaiming for bulls to regain control. For silver, support levels are more uncertain given the move's violence. The market needs stabilization before clear support identification. Any bounce needs reclaiming previous support levels now functioning as resistance. These levels are closely watched by traders and algorithms. Breaks above or below these zones trigger significant order flow that can accelerate moves in either direction. Let me present the complete bearish case because you need understanding all risks. The bearish case starts with failed narratives. Silver failed responding to inflation concerns. Silver failed responding to geopolitical tensions. Silver failed responding to supply constraint stories. When assets fail responding to multiple bullish narratives, that signals the bid isn't there. Capital is frustrated and leaving. The 47% positioning drop reflects that frustration. This isn't small exposure reduction. This is nearly half the speculative interest exiting the market. When that much positioning exits, rebuilding takes considerable time. The Fed regime change under Worsh could maintain dollar strength longer than expected. A stronger dollar is persistent headwind for precious metals. If the dollar rally continues, gold and silver face continued pressure regardless of other factors. ETF mechanics demonstrated during this crash show paper silver instruments can amplify selling as much as they amplified buying upward. The $3.5 billion inflow became selling pressure when prices reversed. The structure itself generates volatility. Rising treasury yields make non-interest-bearing assets less attractive. If yields continue rising, the opportunity cost of holding gold and silver increases. Investors may prefer interest-paying bonds over metals paying nothing. Industrial silver demand may face pressure if economic growth slows. Silver's industrial component makes it vulnerable to growth concerns differently than gold. The options market is now positioned for more volatility. Negative gamma means dealer hedging activity will amplify moves bidirectionally. Until positioning normalizes, expect continued wild swings. That's the bearish case. It's substantial and data-driven. Now the bullish case, because bears aren't telling the complete story. The bullish case starts with observing this was mechanical selling, not fundamental selling. The physical silver market didn't change. Industrial demand didn't collapse overnight. Solar manufacturers still need silver. Electronics manufacturers still need silver. Applications didn't disappear. What happened was positioning unwind, driven by changing Fed expectations and amplified by market mechanics. When positioning unwinds complete, fundamentals can reassert. The selling was about exposure reduction, not demand destruction. Central banks continue accumulating gold at record rates. This structural buying provides a price floor under gold. Central banks don't trade based on short-term technical levels. They accumulate systematically over time. That consistent demand absorbs supply regardless of speculator actions. Long-term gold fundamentals remain strong. Emerging market demand remains solid. Inflation, while easing in some places, still exceeds comfort levels in many countries. High global debt levels make hard assets attractive as hedges. The very violence of silver's move suggests selling pressure exhaustion may be near. When you see 10% single-day drops, that's not orderly selling. That's forced liquidation and panic. Panic selling tends marking bottoms, not beginnings. Sellers who were going to be forced out have been forced out. The marginal seller from here is weaker than last week's marginal seller. Silver's industrial demand from green energy, electric vehicles, and electronics provides long-term structural support. These applications are growing, not shrinking. Short-term volatility doesn't change the multi-year demand trajectory. If dollar strength proves temporary, if Worsh turns out less hawkish than feared, if rate cut expectations return, the entire thesis driving this crash could reverse. Silver could rally as violently as it fell. Prices at these levels may attract physical buying from Asia. China and India have historically stepped in to accumulate during price weakness. That physical demand provides support paper selling cannot permanently overcome. What country are you watching from right now? Drop it in the comments. I want to see this community's location. And tell me whether you're viewing this crash as buying opportunity or warning to stay away. Let me discuss how traders are positioning and what I'm watching going forward. Many short-term traders are waiting for stability before taking new positions. The volatility is too extreme for safe trading with normal position sizes. They're sitting on sidelines until things calm down. Long-term investors are watching for buying opportunities near support zones. They view the volatility as noise and seek attractive entry points. For coming days, I'm watching several key factors. U.S. inflation data will be important. Hot inflation supports the hawkish Fed thesis and could pressure precious metals further. Cool inflation could shift rate cut expectations and support gold and silver. Federal Reserve commentary matters. Any signals about rate cut pace and timing will move precious metals. Dovish commentary supports metals. Hawkish commentary pressures metals. Dollar index movement is critical. If the dollar continues strengthening, that's a headwind. If the dollar reverses, that removes a major pressure point. Bond yield direction matters. Rising yields compete with gold. Falling yields support gold. Geopolitical headlines can change sentiment quickly. Any escalation in tensions anywhere globally could trigger safe haven flows back into gold. De-escalation reduces that bid. Silver positioning data will tell us when the unwind is complete. The 47% positioning reduction is significant. We need watching if that stabilizes or continues. Gold broke below $4,800 and silver crashed 10%. But this wasn't about demand, it was about positioning. A 47% silver positioning drop reflects frustration that silver failed responding to supportive narratives around inflation, geopolitics, and supply constraints. Capital exited at scale. The Kevin Worsh nomination as Fed chair was the initial spark, shifting expectations toward stronger dollar and more restrictive monetary policy. Market mechanics then amplified the move through ETF redemption feedback loops, CME margin hikes from 11% to 15%, and negative gamma in options markets, forcing dealer selling. The $3.5 billion single-day SLV inflow that appeared bullish became a structural vulnerability. When prices fell, redemption mechanics forced physical silver selling into a declining market. $11 billion in price-influenced outflows followed. Institutional investors used late-stage retail inflows as exit liquidity. While retail bought dips, institutions sold to them. Risk transferred from smart money to public money before full unwind completion. Understanding this mechanic is critical for anyone trading paper precious metals instruments. Key levels to watch are $4,750 and $4,700 for gold support, and $4,850 to $4,900 for resistance. Silver needs stabilization before clear level identification. Long-term gold fundamentals remain supportive, including central bank buying, geopolitical risks, and high global debt. Silver's industrial demand from green energy and electronics provides structural support. Short-term corrections are normal after strong rallies and don't automatically indicate trend reversal. However, this move's violence and 47% positioning reduction suggest it may take time for the market to rebuild bullish exposure. Let me leave you with this thought. The precious metals market isn't just about supply and demand for physical metal. It's about the financial infrastructure built on top of that physical market. ETFs, futures, options, margin requirements, all these structures can amplify moves bidirectionally in ways having nothing to do with whether anyone actually wants owning gold or silver. When you understand these mechanics, you can make better positioning decisions. Physical metal cannot be margin called. Paper positions can. Physical metal isn't part of ETF redemption feedback loops. Paper positions are. Physical metal doesn't have gamma exposure. Options positions do. The market just gave everyone a masterclass in how these mechanics can turn against you. The question is whether you learned the lesson. If you did, you'll position differently going forward. If you didn't, you'll likely get caught in the same trap next time. Know what you own, understand how it trades, and position appropriately for the volatility you're willing to accept. Do your own due diligence, understand the risks, be accountable for your own decisions, have a clear plan, and know your time frame. The volatility isn't over. More swings in both directions are likely. But understanding the mechanics gives you an edge most market participants don't have. Drop your thoughts in the comments. Where are you watching from? What do you think happens next for gold and silver? Are the mechanics I explained new to you or familiar? I read every comment and they help shape what topics I cover next. The market has spoken. Now it's about listening to what it's telling us and positioning accordingly. Stay sharp, stay informed, and above all, understand the mechanics. That's the complete picture. I'll see you in the next one.